Now, imagine that you worked all your life. You saved diligently. You trusted the banks. You trusted markets. And then, boom, overnight, it all vanishes. That's not hypothetical. This happened in the 1920s. So today, we are answering one simple question. Why is gold still called a safe haven asset, even in modern markets? And we will anchor this not in charts or hype, but in lessons from the book The Richest Man in Babylon. A book written almost 100 years ago and still explains money better than most finance textbooks today. Section 1. What does safe haven actually mean? A safe haven asset is something investors run towards when everything else feels unsafe. When stocks crash, currencies lose value, banks wobble, and inflation eats purchasing power. Safe haven assets are meant to preserve wealth, not necessarily to grow it fast. Now, gold sits in this category alongside things like cash, government bonds, sometimes real assets like land. But again, gold has something unique working for it. Gold has survived empires, wars, currency collapses, and financial crises. And it did all that without needing a government's permission. Section 2, we are going to discuss the 1920s crash and what actually happened. Now, there was a big crash on Tuesday, October 29th, 1929, and this was termed Black Tuesday. This crash triggered the Great Depression. What followed after was terrifying. Banks failed en masse, people lost life savings overnight, unemployment exploded, and stock markets collapsed nearly 90%. Oh my God. So here is the key part. Paper wealth disappeared. Promises failed. Institutions collapsed. But gold held value. In fact, in the early 1930s, the US government even confiscated gold from citizens because it was too powerful as an alternative to paper money. That tells you something, right? In our third section today, we are going to discuss why gold survives when systems fail. Gold has 3 core properties that makes it a safe haven. Number 1, scarcity. You can't just print gold, can you? Nah. 2, you can't stimulate gold. 3, you can't create gold with policy meetings. Gold supply grows slowly and predictably. Number 2, universality. Gold is recognized everywhere. East, West, rich nations, poor nations, no translation required with gold. Gold is gold. Number 3, no counterparty risk. A stock depends on a company, a bond depends on a government, cash depends on trust in a system. Gold depends on nothing else. If everything fails, gold is still gold. Section 4. Babylon knew this thousands of years ago. This is where the book, The Richest Man in Babylon, becomes powerful. This book teaches us that wealth is governed by unchanging laws, not modern trends. One core lesson here. Gold is a faithful master, but a cruel servant. Babylonians understood this. Babylonians understood that gold represents stored labor. Gold protects against uncertainties. And gold rewards patience, not greed. Another lesson. Gold flees a man who would force it into impossible earnings. Gold isn't about speculation. It's about preservation. And that's how modern investors misuse it. Expecting growth instead of stability, first of all. Stability before growth. This is the key feature of gold. Gold offers you stability. When everything else fails, gold is there as a stabilizer. Stability before growth. Section 5. Gold versus stock. It's not a competition. Here is the mistake most people make. They compare gold's returns to stocks and they say gold underperforms. That's like saying a seatbelt slows you down. No, it doesn't. Gold isn't there to make you rich fast. It's there to make sure you are not wiped out. Stocks are engines, gold is insurance. Babylon did not bet everything on one caravan. Rather, they diversified across trade, goods, and stored wealth. Same lesson, different century. Section 6. Gold in modern crisis. Fast forward to today. In the 2008 financial crisis, gold surged. COVID crash, gold rallied. High inflation periods, gold protected purchasing power. Why? Because whenever confidence in paper systems drops, people run to real stores of value. Gold does not care about interest rates, elections, headlines. It just sits there, quietly doing its job. Just like the Babylonian gold chests did it. Section 7. The real lessons for investors. The real takeaway is not go and buy gold. No. The lesson is this. Wealth isn't built by chasing returns. No. Wealth is preserved by respecting risk. Babylon taught us, pay yourself first. Protect your wealth. Don't confuse speculation with wisdom. Gold represents financial humility, an admission that markets, governments, and humans make mistakes. And when they do, gold remembers. If you enjoyed this breakdown and want more investing lessons anchored in timeless books like The Richest Man in Babylon, The Psychology of Money, and Same as Ever by Morgan Housel, subscribe to this channel because markets change, but human behaviors do not change. And neither does gold. See you in my next video. Bye.